With that, I have that we are at the top of the hour, and I'm going to formally welcome everybody into today's program, the Compliance Forum 2019, a look back and what lies ahead. A couple of short introductions and housekeeping, and we'll be off and running here today. For those of you who don't know who I am, my name is Jared Moyer, and I'm going to lead us today through the Compliance Forum, this look back and what lies ahead. But I'm not alone today. I do have a teammate. She'll be in momentarily, Diane Dean. Her role is going to be as moderator today. She's going to be taking those questions that you submit along the way. What we're going to try to do today is reserve about 5 or 10 minutes at the end of the program to answer your compliance questions. Now, how do you submit those questions? If you use the Q&A button. So I've been talking about the chat button as far as accessing the materials for today's program. That Q&A button is the one that's going to be your link to Diane, our moderator, for the questions for today's program. If you have a question as it relates to the topics at hand today, you can go ahead and submit them to Diane, and we'll try to get as many as we can in that last 5 or 10 minutes of the program today. And maybe we'll be able to have a little more time, but that's kind of what we're shooting for based on the material that's in front of us. Now, today's agenda, pretty simple and straightforward. We're going to look back at 2019. In fact, we're going to go just briefly into 18 because we do these about every October. So there's a little bit hanging over from 2018 that wasn't discussed a year ago when we did this. And then we're going to look ahead. What's off there in the future in 2020 as far as letting management, the board, know what's going on. Maybe getting on your radar so that you can make sure you've got resources and you can plan accordingly for those things coming down the pipeline. Noteworthy considerations. There's always things going on that aren't necessarily on somebody's agenda, but they're a big deal. And so we'll talk about those as we get towards the end of the program today, and then hoping to have 5 or 10 minutes for Q&A at the end of the program. Now, I also want to give kind of this overall caveat with today's program. It's not an all-inclusive. These are majors for the most part. We try to keep them to compliance. We're not going to talk about safety and soundness for the most part, outside of flood insurance, things like that. We're also not going to be able to get in-depth nuts and bolts details as we go through the program today. I'm going to try to give you nuggets of information, that things of value that you can expand on after the program, or maybe it's a checklist for you to go get additional training where there is nuts and bolts and in-depth information discussed. And I'll talk about some of the things that we have to offer that can help you out with that as we go through this as well. But today is kind of a 10,000 or maybe even 25,000 foot view of a look back and what lies ahead. Now, if you're looking at that outline, I want you to go ahead and just kind of flip through those pages that are alphabetized lettered at the front of the program. I want you to find page number 1 in the materials and go ahead and navigate there. What we're going to do is start really in 2019. It was the tail end of 2018, actually, but page number 1 in the materials, letter A. The first item that I want to bring to your attention was something that came out last December, and it was this joint statement on what they call innovative efforts to combat money laundering and terrorist financing. If you were to go to that link, and maybe I better go off on a tangent here and kind of explain, what we've tried to do in this outline is give you kind of the headline news story, the headline paragraph, if there is one to be had, and a link so you can go read more about it. Again, not nuts and bolts today, more trying to make sure it was on your radar. You can check that box, or it's something you got to go back and look into. We're going to give you a starting point so you don't have to go fish for it yourself. That's the link in the materials, and that link is available electronically. You can click on those, and it'll take you directly to the source document. So back to this joint statement. If you were to read through that paragraph or even go click on that link, the idea here is that they're encouraging banks. So it was all the regulatory agencies collectively putting out this statement that encourages financial institutions to look to technology to keep up with the pace of money laundering and terrorist financing. Maybe another way to explain it is this. When it comes to money laundering, terrorist financing, the bad guys out there, the illegal activity, the criminals, all that stuff, we'll throw it in one basket. The liars, the cheaters, the stealers are generally a step or two ahead of the financial institutions. But we try to keep it at a step or two only. We don't want to fall too much further behind. They're learning new ways to lie, cheat, and steal every day, and we're trying to keep up. This is an encouragement by the regulators to the financial industry to say, hey, make sure you're looking to technology to keep pace. Make sure you're exploring new avenues to make sure that you're identifying money laundering, terrorist financing, and are aware of the ways it's being done with new technology. in order to mask it and layer it and put shells up so that we don't see it. Make sure that we're paying attention to that stuff. So that's what's going on in letter A there. Make sure you're utilizing technology and looking to it. Don't be afraid of it. Letter B, let's go there next. Letter B on page number 1 is going to be private flood insurance final rule. This is really, from a regulatory perspective, are really the new rule that came out. January of 2019, you'll see the date there is when we were provided with that final rule. The mandatory compliance date was 7/1 of 19. Now, I'm going to go off on a bit of a tangent here on this just to make sure that everybody understands how this worked. The Biggert-Waters Flood Insurance Reform Act, that'd be 2012, actually required that financial institutions accept private flood insurance. That's the mandatory compliance date. But we didn't have the criteria that was necessary to measure what we call a private flood insurance policy. That criteria is what this January 19 rule was all about. So January 19, we get the criteria that we're supposed to measure private flood insurance policies by. The mandatory compliance date then for using that criteria is July 1st, 19. So it's a misconception to believe that you had to start accepting private flood insurance on July 1st of 19. That was actually a 2012 Biggert-Waters law that we've been supposed to have been complying with all along. We just now have the criteria. Now, in letter B, relative to this rule, there's 3 things, and I'll try to go to at least that level here today. There's a you must accept, and then there's 2 you may accepts. Right? Let me elaborate. You must accept private flood insurance that meets the definition of private flood insurance. I know that sounds really dumb, but that's how they did this. They said, all right, there's private flood insurance, and then there's private flood insurance. If it meets our definition of private flood insurance, then the banks have to accept it. But then there's 2 other types of private insurance. There is private insurance that doesn't meet the definition of private flood insurance, and that's discretionary. You don't have to accept it. You can tell the borrower to go get a private policy that does meet the definition, or go look to National Flood Insurance Program, the government-issued version of insurance. The third type of insurance that this addressed, this private flood insurance rule, so you have the you must and then the discretionary. The third one is mutual aid society plans. And we haven't run into a lot of these already this year. I think we've probably taught private flood insurance 4 or 5 times in the last 6 months. I think I've had one, and I don't even want to call it a policy, one type of protection plan from a mutual aid society presented to us, and we could not find that it fit the regulatory criteria. There's certain criteria that mutual aid society plan has to meet. And so the point is, you need to be prepared for all 3. There are certain types that you have to accept by law. There's certain types that you have some discretion on. And you'll have to make sure that you've documented where you stand with those and that people within your organization know which way to go on those. So that was January of this year that came out. The requirement to comply was July of 19. The other thing I'm going to do as we go through this, you may be looking for more in-depth training on this. I want to make you aware that we do have a private flood insurance webinar. It's a 30-minute webinar that you can go check out in our store if you'd like the more in-depth nuts and bolts training on this. Letter C, towards the bottom of page number 1, brings us back to the Truth in Lending Integrated Disclosure Requirements. This would be TRID. And I was really excited when they started posting Q&As back at the end of January of this year, only to be disappointed when I actually read the actual Q&As. They're not terrible, let me put it this way, but they didn't really give us anything that was new, save for one item. So when you look at letter C and the corrected disclosures and the 3 business day waiting period, those Q&As don't give us anything that wasn't already in the regulation. They merely state it a different way, but make references to what was already there in the first place. So nothing new under the sun there. The one new thing that we've really received through the CFPB's TRID frequently asked questions is that of letter C2, and that is the model forms. And it was kind of interesting. What they said through this Q&A is that if you rely on the model forms that they put out with the original TRID rule for compliance, yet it doesn't match up exactly with what the regulation states, that you've been deemed to comply and you shouldn't be cited for that. So the regulation might say to do, round to this or cut off trailing zeros. And I'm just using examples here, but the regulation doesn't quite say it that way. If you followed the model form, you're compliant and should not be cited for that. So that is the one item that was not part of the regulation already that we got through the Q&As. And again, we've got several TRID training webinars out there as well for you to navigate if you're interested in that. Let's go to page number 2, letter D at the top, the payday rule. Do me a favor, pick up your pens, just write down somewhere off in the margin on the right, stay tuned, because that's the ultimate takeaway that you're going to get from this. So that payday rule, the mandatory compliance date was really supposed to be August of this year, but it was delayed in June until November of 2020. And then there's also this stay, and I believe it's through the Texas courts. That's off the top of my head, but it's also interplaying with this. This thing's not ready to go yet, so don't sweat it just yet. The payday vehicle title and certain high-cost installment loans. Here's the story on this. If you want to know more about it, I don't want to get into too much details here today, but we do a half-hour webinar where we covered the are you in or are you out? And then if you decided that you were in and you're going to be subject to it, there's a whole lot that comes with it. In fact, so much so that it takes 2 hours to cover all of the requirements that go with a bank that's subject to the payday rule. Now, keep in mind, you don't have to do anything just yet. We've got this delay until November of 2020, and then there's this stay that's been continued that's going to affect it as well. So stay tuned. That's why I started with that. Letter E, this is part of the Economic Growth and Regulatory Relief Act from May of 2018. It is residential property assessed clean energy financing. This is an advance notice of proposed rulemaking. Here's the thing. If you've ever studied or ever came across one of these PACE financing situations, they're not underwritten the same way a typical home loan is. They don't take into account, in most cases, things like credit scores or debt-to-income ratios. And so it's non-traditional underwriting that's used to come up with whether or not somebody qualifies for what they call PACE financing, this clean energy financing. And so the Economic Growth and Regulatory Relief Act said we need to have some measuring sticks within truth in lending when it comes to ability to repay. We need to know what liability is going to be. And so the CFPB is charged with writing regulations to carry this out so that there is a more traditional underwriting that is applied to this type of financing. We're only at the advance notice stage here. We don't even have a proposal. So this is like the thing that comes before the proposal and then the final rule. So a lot to be done yet on this one, but it is something that happened over our shoulder looking back, and so do want to bring it to the table. Letter F, this is a big one as far as the things that we're going to talk about today within the manual. This HUD versus Facebook. This thing's not done yet. Do me a favor, pick up your pen somewhere next to letter F and write down fair lending, fair housing, and then just advertising in general. So fair lending, fair housing, and then just advertising. Because there's a whole lot packed into this thing. So HUD has sued Facebook, and for the most part what it is it's about targeted ads, allowing third parties or maybe even directly banks such as yours to use information that Facebook has accessed through their users, but that information is protected class information. Things like race, sex, ethnicity, gender, age, marital status, all of those things. Facebook has that information, and in the past had allowed users to take that information and use it to target things like home loans and other types of products and services. And we know in the financial services industry, we can't do that because of fair lending, the Fair Housing Act, and all the things that go into place there. But it's more than just things like race, sex, ethnicity, age, marital status. It's the use of other information that could be used as a proxy to identify with that protected class information. If you have not read, and you're in charge of compliance or advertising or home loans in general, if you haven't read this HUD v. Facebook, and you can click on that link there when we're done with the program today, it's only about 12 pages long. But if you skip over the first couple of pages, get to the meat of it, you'll be shocked at the information that Facebook allowed different marketers to use to market products like yours to the Facebook users. Things that are about protected classes or proxies that could help us arrive at protected classes. It's definitely an interesting read. Now, I'm also lucky enough that I get to go and attend some national conferences once in a while. And last year at the American Bankers Association conference, the third-party marketing was a huge topic that was discussed. And one of the things that we're hearing through regulatory exams is that if you are outsourcing your marketing to a third party, the regulatory agency was going to want to know who they're marketing the information to, what type of information is being marketed, and how they sliced and diced it. Now, what we're hearing from some is that the third-party marketer is telling the bank that that's proprietary. I don't think that's going to cut it. The regulator is going to want to know how you sliced and diced it, whether you did it directly or indirectly through a third party. They want to know what's in your little black marketing box, how you sliced and diced the data to get it to the user, that is Facebook, that is whatever out there as far as targeted ads go. So make sure you're aware of what's going on there. There's also a case in the state of New York, and there are several others, some of which have been settled by Facebook at a lower level. And it's not just Facebook, but it's third parties that are marketing your products and services. You need to make sure that you've done the due diligence and you're getting proper oversight and you know what's going on in that space. Let's go to the bottom of page number 2, letter G. HMDA modified loan application registers released. The reason that we bring this to our attention is in March of this year, this is the first time that the data from a HMDA standpoint has been put out to the public based on the expanded data points. It's also now at a point where it used to be where if somebody wanted your data, they had to walk through your front door, they had to communicate with you and say, I'd like to see your modified loan application register, the place where information at your bank goes to die. So you would know, you'd have it on your radar that somebody was going to go snooping in your data. Well, now it's out available for everyone in the free world to see online. You won't know who's looking at your data. I can look at it this afternoon and you won't even know it. So you need to be even more prepared than ever. So first off, it's out there. And for the first time, the expanded data points. Now, the publicly available information is modified so that we protect privacy. You'll find that in that paragraph as well. But you need to make sure you know your data. Make sure that you have had a discussion with management about what you believe your data says about your organization so that they're not surprised when somebody talks to them about it or shows up in a newspaper or in an email or some news company. Make sure you know your data. It's publicly available. You won't know who's asking for it, but you need to know your data. Page number 3, letter H. So this is the Reg E and Reg Z prepaid account rule. Essentially, this had a mandatory compliance date of April of this year. What this brought to the table was protections under both Reg E and Reg Z, truth in lending, for prepaid cards, those cards that meet the definition of a prepaid card, and there's criteria for that. If it met that definition, consumers were now afforded additional protections under Reg Z and Reg E for those types of cards. If you have those, if you've offered those, make sure that you have dotted the I's and crossed the T's in that space. Let's go to letter I next. We've got the CFPB updating the construction loan frequently asked questions. For those of you that are listening that do construction to perm, all in one closing. So we do the application and we close the loan, and it's got a built-in automatic modification to go from a construction loan to a permanent loan. So there's just this one closing. These Q&As that were updated in April of this year are for you. They have to do with specific fields for HMDA reporting as it relates to loan terms, non-amortizing features, as well as there was one other, the initial interest rate adjustment. So make sure if you do that type of product and you're a HMDA reporting bank that you're following the guidance within those Q&As that were put out in April. Letter J is another CFPB publication. They put out a fact sheet on assumptions as it relates to TRID and coverage. If you do assumptions for mortgage loans once in a while, you'll want to make sure that if you do encounter one, you check to see how it intersects with TRID. And the quick reference is this assumptions fact sheet that the CFPB put out in May of this year. Letter K at the bottom of the page. We've got the HMDA proposal for the reporting thresholds. Now, let's talk about what they currently are. So some of you listening maybe are not a HMDA bank. This doesn't apply to you. But if you are a HMDA bank, this is very much something that should be something that's on your radar. So currently, the thresholds for HMDA reporting closed-end loans, obviously you had to have originated a loan. That's the first checkbox. But then the current threshold for closed-end is 25 loans. And the open-end threshold is currently 500. It was set to go back to 100. We now have a, and Diane, if you could come in here, is it a proposal or a final rule that's going to now permanently set that at 200 in 2022? I know that just happened.
The open-end threshold just got finalized, so that is set at 500 until 2022.
Okay, so it's set at 500 till 2022. Then it's going to go to 200. Is that correct?
Yeah. Yes, I believe if they went that far, even.
Okay, they maybe didn't go that far, but the idea is we're good until 2022. It was set to expire 2021. Now it's 2022. The closed end is probably something that we're more interested in at this point. It's currently 25. Their proposal is to go to 50 or 100, and they gave us both. They also said through the original proposal why they didn't go to 500, why they didn't go to numbers higher than those two 50 or 500 numbers. I believe my crystal ball is that we're going to end up with a threshold that's going to be 100. When? Don't know. We're hearing that it might happen sometime during the year 2020. Would have been nice to have that out before the end of 2019 so that those of you that maybe would fall out of HMDA wouldn't have to deal with it at all. I think it's a bit of a disservice to actually make you start the year and tell you 3-4 months in, oh, sorry, you didn't have to do that. We're changing the numbers on you. So I guess stay tuned on this. Believe it or not, comments on that proposal are due today. If you still want to submit a comment letter, Diane, I believe you've put one together. You can get it from our website and put your name on it and submit that yet today. But those comments for that reporting are due today. Now, along those same lines with HMDA, if you go to page number 4, there at the same time they did that proposal for the thresholds, they also did an advance notice of proposed rulemaking for data points and loan coverage as to whether or not the way they're doing it, what they're doing is working. This one's more long-term. Like I said, this is an advance notice of proposed rulemaking. What that means is this is what they're thinking about. They're looking for us to give some input on that, and then they're going to propose something. If you want to give input on that, that comment also is due today, and we have a comment letter that you can download from our website and provide input, but you'll have to get it in today after putting your name at the top. Letter M, debt collection practices. So Fair Debt Collection Practices Act is what this is. It was a proposed rule back in May. Many institutions listening probably go, well, we're not subject to the Fair Debt Collection Practices Act. And the reason for that is you're only subject to that act if you collect the debts of a third party. So you can collect your own debts and you're not subject to the Fair Debt Collection Practices Act. But if you collect the debts of a third party, then you are. Now, the reason I bring that up, because I don't want some of you, again, this doesn't apply to, but I wrote down the term abusive underneath letter M. I just wrote down the word abusive. The reason I wrote that word down is because we thought the same thing. We don't have a ton of clients that are subject to the Fair Debt Collection Practices Act because they just collect their own debts. But we took a closer look at this proposal, and while it doesn't apply still, it still won't apply to those banks. They are using the term abusive rather interestingly. The term abusive has yet to be defined per the Dodd-Frank Act by the CFPB. We're still waiting on that. But if you want to read between the lines and see what they're looking at as far as what they believe the term abusive to mean and how it's to be used within the financial industry, go give the proposed rule for this Fair Debt Collection Practices Act a read. They use the term abusive in there, yet it has not yet been defined by the Dodd-Frank or per the Dodd-Frank Act by the CFPB. They really painted a broad brush as it relates to the use of that term abusive as it relates to acts or practices under the Fair Debt Collection Practices Act. I do think there's implications there for other rules down the road relative to that term. So we're going to pay close attention to how this thing turns out here, even though it may not directly apply to many of you. The use of the term abusive in there is rather interesting. Letter N. We've got the review of the Reg E opt-in rule. So that was 2009. Think ATM and one-time debit transactions. What that rule required is for the, now it's the CFPB, to take a look back and say, all right, is this working the way it was intended? Well, a couple of things have happened. The CFPB is there on overdrafts. So as far as overdrafts are concerned, that's something that's always kind of on their radar. Now it's slipped off their agenda and back onto their agenda. And I think it's become more mainstream again after falling kind of along the side there under Mulvaney. I think the current leaders at the CFPB have made overdrafts a big deal again. I think you're going to see it back on the agenda here shortly. But in the line of thinking with them looking at overdrafts the way they are, just a couple years ago, they put out some prototype revised versions of that opt-in notice. I think we would all agree if we went back and looked at the opt-in notice under Reg E, the 2009 version, it's not a real great notice. It's not consumer friendly, and they could have done better. I do believe that the proposals that were put out by the CFPB are better than what we originally had, but it's a work in progress. So between that, the overdraft reform that the CFPB seems to be pushing towards, I do think that there's going to be some changes as it relates to this topic down the road. I just don't know how much. So that's on the radar. I wrote down stay tuned. We'll see what happens with all the overdraft stuff. I think that's going to kind of all happen together if I were to guess. Let's go to page number 5. Letter O at the top is some more TRID FAQs. So we had some that came out in January. Here's another round in May at the end of the month. This one had to do with construction loan coverage and construction loan disclosures as they relate to TRID. So again, neither one of these are going to tell you anything that the regulation didn't already tell you. Yes, construction loans are subject to TRID. If they're consumer purpose, closed end, secured by dirt, you have to play the TRID game. And if you have to play the TRID game, it means you're going to provide loan estimates and closing disclosures. That's what the second question is about as it relates to this. Here's the thing. If you're looking for in-depth details on TRID and construction lending, we've got a 2-hour webinar that you can go check out. It's on demand on our website. Another one of our very popular ones as far as on demand is concerned, if you need the nuts and bolts training there. Page number 5, letter P. Let's go there next. One of the things we try to do at Bankers Compliance Consulting is read all of different regulators' periodic publications as it relates to, like the CFPB has their spring and fall agenda. They have their supervisory insights. The FDIC, the OCC, they all have their own versions. Now, sometimes we don't get a whole lot out of them. Sometimes they're just words printed on paper, and it's like, yeah, okay, didn't get much there. Probably one of the most notable issues that I've ever read by the FDIC is what you'll see here on page 5, letter P. Just a ton of things that we teach a lot of in-depth on as it relates to our training programs, they brought up in this one issue of their supervisory highlights. So I'm going to highlight a few of them here. And again, my takeaway to you would be make sure that you're checking the boxes on these ones and these things aren't falling through the cracks, especially if you're FDIC regulated, because this is on the top of their to-do list when they come into your organization. Letter P1, overdraft programs. There it is again. That's one that's going to creep up throughout the program today. Debit card holds and transaction processing. Let me give you a different set of words here to describe what this is about. Ledger versus available balance and how you charge overdrafts. So what does the system look to when they charge overdrafts? Is it to the ledger balance or the available balance? And I'll just kind of leave it at that. One is worse than the other. And if you go read this, you want to make sure that you're on the side that is the better, as opposed to the more UDAP versed as far as how you're applying your overdraft fees relative to balances that are being used. The second one is RESPA Section 8. And RESPA Section 8 is not something that's new. It's been around for a long time. It's just had a renewed emphasis. The CFPB has brought that back. And while I can't say that they've directly honed in on smaller institutions, there is definitely this increased emphasis or renewed emphasis on RESPA Section 8, referrals, and all of the things that go along with that. So much so that we put out earlier this year a 1-hour RESPA Section 8 webinar that you can go take advantage of on demand in our store if you want more nuts and bolts details there. But make sure that you're on top of RESPA and Section 8. Number 3, Reg E. Think unauthorized transfers. And so in Reg E, there's 2 different areas that deal with unauthorized transfers and consumer and financial institution liability. And one of the things that often intersects with this requirement of resolving errors and unauthorized transfers is there's a ton of misconceptions and misunderstandings about timing. There's a lot of misunderstandings about the 60-day rule. There's misunderstandings about whether or not you can make people go to the merchant first, and you can't, by the way. You can't make people file a police report. There's just a whole lot of ways that Reg E can go wrong. And while you can't be required to do a reimbursement under Reg E, they can claim UDAP, unfair, deceptive, or abusive acts or practices, and to go that route with you. And we've seen that done. Make sure that your Reg E disputes program, how you resolve errors, has been measured as far as compliance with Reg E and some of these misconceptions that are out there. That Reg E section that the FDIC wrote is definitely worth a read. If you go through that and you've got issues, we'd love to help you out. We do a 2-hour webinar about Reg E that really hones in on the minute detail that is unauthorized transfers and the liability both on the consumer side as well as the financial institution side. Number 4, if you do skip a payment loan programs, a lot of times people do these at Christmas. I worked for a bank once that did it. We sent everybody a letter that said, hey, you can skip your December payment for your installment loan, and you tack it on to the end of the loan. Well, there's rules. There's also state laws that get involved with that. Make sure that you're up to speed with what the regulatory expectations are with those skip a payment programs. And the last thing, number 5, is another thing that's not new yet has somehow slipped through the cracks for many, and that is the disclosure of the term finance charge on periodic statements for open-end credit products. You see, on open-end credit products, when you disclose a disbursement to pay for a charge that is like a finance charge, that has to be disclosed a certain way. And if you don't do it correctly, under open-end credit rules, there's no tolerance. You don't get any grace when you make mistakes as it relates to disclosing things like finance charges on periodic statements. And oftentimes they're system-wide issues, which means you've got this recurring violation that has no tolerance. And what ends up happening is they end up being a potential reimbursable when you go through an examination. And so you want to make sure that you are properly disclosing finance charges when you disclose periodic statements for open-end credit products. That's what that P number 5 is driving home at. Page number 6. Wow, it seems like a lot's gone on in the last year. We're already a half hour into this. Page letter 6, letter Q, the Reg CC final rule. I know everybody thinks it's been kind of a down year. There's still a lot of things that go on. They might not all be majors like TRID and HMDA that we've had the last couple of years, but a lot of little things add up. And as we were putting this together, that's kind of what we realized as well too. So back to page number 6, letter Q, the Reg CC final rule. There's 2 things going on in there. The one is a minor deal that they extended coverage to like American Samoa, things like that. That's not as relevant as the adjusted dollar amounts that are coming. So the thing in Reg CC, we've got to make the first $200 available. There's the large deposit amount over $5,000, the repeated overdraft 5,000 numbers. All of those numbers are going to be set to go up July 1st of 2020, and then they will increase with the consumer price index inflation, if you will, as we go into the future. They won't be set standards anymore. They will go up with the for inflation. It'd be in the 4th line in that paragraph that is letter Q. So make sure you're set to go next July when that comes around. Letter R. We're back to fair lending. So we've talked about fair lending once prior in the HUD v. Facebook thing. Here directly from the CFPB, we talk about fair lending again. At the end of June of this last year, they wrote their fair lending report. And part of that fair lending report, the whole thing was published in the Federal Register, but the opening part of it was actually a letter written directly to our industry from the CFPB Director Kraninger. And I want to just highlight some things. This is just 2 paragraphs from that letter. The letter's longer. If you want to go read it, you can click on that link. But I'm going to read a couple things out of this paragraph here. Underneath letter R, the 2nd line, the right-hand side, it says, the Bureau will continue to vigorously enforce fair lending laws. I'm going to skip down to the next line, right-hand side. The Bureau will continue to explore cutting-edge fair lending issues. And then in that last paragraph, just above where she signs off, excited to take the Bureau's work in fair lending to a new level. I don't think any of that's bad, by the way. Those that discriminate should be caught. Those that are using protected class information and using it to discriminate should be caught. There's no question there. There's reasons those laws exist. I'm including this because I want you all to be aware that fair lending is going to remain the top priority. And I would say across all regulatory agencies. I don't think it's just the CFPB based on what we hear from other regulators, we see in examination reports. And there's different types of discrimination. We don't have time to get into it all today. There's the outright, what we call overt discrimination. Okay? Those stick out like a sore thumb, but there's other types of discrimination that, while it may not be intended, that happen beneath the surface, can cause problems for bank. Things like discretion, things like disparate treatment and disparate impact. Those can cause issues and the bank not even know what's really going on. So we want to make sure that we continue to beat the drum that is fair lending. Don't take your foot off the gas pedal. I guess that's the takeaway here. The regulatory agencies, rather than letting up on fair lending, I think they've put the accelerator to the floorboards. And make sure your management team, make sure your board of directors understands that fair lending is even more important today than it was yesterday. They need to be getting reports, information on fair lending. Exceptions need to be monitored and controlled. And so management needs information in order to manage it appropriately. Let's go to page number 7. Oh, I'm sorry, I skipped over one. Page 6, letter S. I skipped over elder abuse. I don't want to do that because I have, this is huge and very widespread written next to it. So the CFPB put out a couple of things in the last year on elder abuse. They put out a recommendations and how to prevent and respond in incidents of elder abuse. They also put out a report about suspicious activity reports and elder abuse back in January of this year. Collectively, these are 2 items the CFPB has put out. Other regulatory agencies have put out other items on it. This is widespread and it's sad. We need to do our part to make sure that we're monitoring for elder abuse. There's a thing in the Economic Growth and Regulatory Relief Act that says if you reach out to law enforcement, if you reach out to regulatory agencies when you believe that somebody is been a victim of elder abuse or you believe it's going on with one of your customers, that there's this safe harbor-like approach that will be taken because you've reached out to law enforcement. I know a lot of financial institutions have asked questions of us about privacy. Privacy has an exclusion when we're dealing with criminal or illegal activity. And so don't sweat the privacy issue when you believe that elder abuse is something that is in front of you. Again, this is a big deal. It's widespread and it's just sad at the end of the day. Do your part to try to mitigate and prevent elder abuse along the way. Let's go to page number 7, letter T at the top of the page. This is another BSA AML statement. Again, it was joint. All regulatory agencies signed on this together. This is really just a reminder. We took a few calls on this over the course of the year when it came out. And what's this all about? All they're doing is reminding financial institutions that when a bank goes through an examination, it's not a full audit, and that it's going to be risk-based and it's going to be driven by your risk assessment. When a bank wants to know how they're really doing with BSA/AML, that's what the independent audit's for. The independent audit, the analogy I'll use is is going to the doctor for a physical. Okay? You're getting a full-blown physical when you do your independent audit. When the regulatory agencies come in and they do an examination for BSA/AML, it's a checkup. They might look here, they might look there, but they're not looking everywhere like when a full-blown physical happens under your independent review. So this is just a reminder that they're going to continue to do risk-based BSA/AML examinations. They're going to use your risk assessment as a springboard. They're going to use your BSA independent audit as a springboard to help them focus on the risk within your organization. Make sure management and the board knows that going into your next BSA/AML examination. Letter U, this is a Truth in Lending Act issue. This is the Qualified Mortgage Definition Advance Notice of Proposed Rulemaking. Here's the story on this thing. When the ability to pay rules came out, one of the types of qualified mortgages that was included was this GSE-QM. Think like the Fannie Mae, the Freddie Mac, that type of qualified mortgage. Essentially, if you submit to their underwriting program and you get that it's approved or accepted, then it's automatically a qualified mortgage, assuming you didn't lie, cheat, and steal your way to get there. Well, that thing had written into the original rule, was provided a death sentence right out of the gate. Sets to expire January 2021, and that seemed like a long time when the rule came out. Well, January 2021 is just around the corner, a little over a year away. And so what they're saying here through this advance notice of proposed rulemaking is they'd like to let it die. they're not looking to renew that temporary GSE qualified mortgage category. But what should we do instead of that? What are the other options out there? And so they're looking for us as an industry to give feedback to them. And hopefully you're able to comment on that and give them some feedback as they look towards a proposal to address the changes that are required as a result of the original qualified mortgage rule. I would write down, stay tuned here. There's more to come. Letter V, down at the bottom of page number 7, we're back to TRID again. At the end of July, they issued 5 more frequently asked questions. By the time we got to July, I'm like, all right, these really aren't new. And again, the only one that was really brand new to us is that model forms one. So if you take a look at page number 7, the questions are relative to like, when do I provide a loan estimate? Can I ask for information beyond the TRID 6 pieces? What about verification documents? What about pre-qualifications and pre-approvals relative to the minimum information that I can require up front? I'm going to wrap these all into one here. These are questions that were asked by the industry that the TRID rule from day one had the answers to. And so these questions, I appreciate them putting them out. There's nothing new under the sun here. These are just reminders that you can't do some of this stuff. Let me address number 2, additional information beyond the TRID 6. You can ask, but you can't require. And I don't care whether it's a pre-qualification, a pre-approval, whatever you call it, you cannot require anything over and above the TRID 6 until the borrower has the loan estimate in hand and they've told you they want to move forward. Then you can require them to submit additional information. So the same thing would go with verification documents. If you're a bank that's still out there requiring a purchase agreement in order to deliver a loan estimate, you have big problems because that's not something you're allowed to do. You can ask if they have a purchase agreement, but you cannot give any indication that one has to be provided in order to apply for a loan or to get a loan estimate. And so those are addressed yet again in these frequently asked questions, the bottom of page number 7. Well, we're coming to the end of the look back section here. The last item we have is page number 8. So this takes us through the end of August as far as majors, if you will, go. The FFIEC announces the availability of 2018 HMDA data. Now you might go, wait a minute. I thought we did that back here at the bottom of page 2. Kind of, sort of, yes. So back on page 2, letter G, that was the initial release of HMDA data under the new rules with the expanded data points. So 2018 data in 2019 being released. Well, in August, they re-released the data with late filers, corrections, and updates because it's new information, right? And so financial institutions did their update and they went, or did their initial submission and went, we made mistakes, or we have updates, or we have late information. And so that's why the numbers changed from page 2 to page 8 if you were to go read further on those links. So just really it's the same thing, just an updated version of it. So that takes us through what has gone on in the last year. I know it didn't seem maybe like a lot as you were going through it because there weren't a lot of new issuances of regulations, but there were a lot of things that were on the table and a lot of reminders put out there by the regulatory agencies. Now, before I get into page number 9, more details here, I've got asked this question as I've done similar versions of this presentation in the last few months. Well, what about that Regulatory Relief Act? Isn't there some more unwinding of the Dodd-Frank Act? And the answer is not really. If you're waiting for that thing to unwind the Dodd-Frank Act, that's not really happening. There's a few things hanging out there that we'll get into as we look ahead here. But the major relief was HMDA and small filers, and that happened already. So as far as I'm concerned, looking at the Economic Growth and Regulatory Relief Act of May of 18, if you've got management and the board that are thinking that something big's coming because of that, it's not. That would have to be another law that happens down the road, but not through that one. There's no big compliance saving coming from anything that's still there. With that, let's go take a look at 2020 and see what's ahead. So page number 9, we're still waiting on it. This is one of the Dodd-Frank Act remaining goodies that are out there. The small business data collection for women and minority-owned small businesses. Think HMDA-like data collection for commercial loans. That's what this is going to be. You can see it in letter A in the heading there on the far right-hand side. It's in the pre-rule stage at the CFPB. They're getting a lot of pushback for not having this done yet. I expect this one to start moving forward at a faster pace than what we've seen in the past. They've really kind of dragged their feet on it. I think we're going to move forward in a quicker motion than what we have as we look back to the Dodd-Frank Act. So look for that to start moving. Letter B, we've got the HPML escrow exemption. Certain banks that meet certain asset thresholds and other criteria, what they're going to do is allow you to not escrow for HPMLs. And that hasn't happened yet. We're waiting on the CFPB to write regulation for that. This is part of the Regulatory Relief Act. Again, there's some relief here, but not a ton. Many of you are going to be like, we didn't get anything because we didn't meet all the criteria. Or we already escrow, thank you. Therefore, we probably aren't going to get out of this, is the way it looks. Letter C is something that interests me and probably many others in the industry. Reg E's been around quite a while, but has not kept up with technology and innovation as it relates to things like unauthorized transfers and disputes and just how technology has changed the payments game. The CFPB is looking at modernizing Reg E. I think that's needed. That means that new regulations are going to happen, and there's going to be things we're probably not happy with as far as changes, but it's necessary to move forward in this area. So that's a long-term action, not something that's going to happen right around the corner, but on the to-do list. Page number 10, letter D. I mentioned this was coming. The abusive acts or practices. The CFPB still has to deal with that. That's another one of the Dodd-Frank things that are hanging out there. They went a long way in giving us kind of a crystal ball look into this with the Fair Debt Collection Practices Act. That's worth it. If you've got some extra time and you want to do some reading, go read that Fair Debt Collection Practices Act proposal, even though it may not apply to you, to get some insight on what they're doing with the term abusive. I think that's going to go a long way with how they handle it here in this letter D space and actually writing what they believe abusive to mean. We're going to finish up this look ahead with the overdraft reform here. I've got some noteworthy considerations we'll do on the next page, but the last one in this section is going to be overdraft reform. I went and read both of these bills in great detail because I think overdraft is something that does catch the attention of boards and management, and we've been hearing about it. We thought it kind of fell off, and now it's back on the agenda again as far as the CFPB, or it appears it is. I guess I can't say that it's back on their agenda, but both the Senate and the House both have bills in this session of Congress to deal with overdrafts. Neither one of them are good for banking as far as your bottom lines are concerned. Whether it's the Stop Overdraft Profiteering Act or the Overdraft Protection Act, if you go read both of those bills, it really, if either one of them would pass in any way, shape, or form that they currently are in, it would really limit your income and how you do business going forward as it relates to people who overdraft their accounts. It is night and day difference compared to what you're doing today. It's worth maybe just a read of the summary. The summaries are pretty short on these. You may want to click on those links, read the summary, and maybe you can give management a little brief on what's going on, and then they can go talk to their congressmen and women about these acts and whether or not they should be voted in the way they are, because neither one of them, like I said, are good for banking. Speaking of overdrafts, I've mentioned it several times today. I also want to mention we do an overdraft webinar that is 2 hours long and gets all of the best practices, the guidance, the opt-in, all that's covered in that if you're looking for in-depth training in that area. We're going to finish up the program today, and how the hour just flies by when we look back and look ahead, with some noteworthy considerations, things that aren't necessarily on a specific document, but things within our industry that gather a lot of attention. We've talked a little bit about fair lending already. It continues to be a top priority. If you were not able to make it, just earlier this month, the Consumer Compliance Outlook Live did a free webinar. They do this about every year specific to fair lending. You can go get the archive for that. If you Google Outlook Live Fair Lending Webinar, again, Outlook Live Fair Lending Webinar, it's free, and it's the regulatory agencies that put it on, the latest, greatest with what they're seeing in fair lending. We also provide fair lending insights as far as details are concerned there. We do it roughly the first part of the year. But there's a lot of information out there. Make sure you're staying on top of the top issue in regulatory compliance. Letter B talks about compliance management systems. The acronym is CMS. I'd have you write the word culture down somewhere underneath letter B. You need to be working on your bank's culture, which is a direct correlation of your bank's compliance management systems. Your culture is very important. If you read the regulatory agency supervisory insights, publications, bulletins that they put out about board and management level compliance and management, you're going to see the word culture intertwined in there a ton. I don't have a lot of time to get into it today because I do want to get to some of your questions. But if you were to go to our website, to our training and our webinars, on demand, we have 3 free, doesn't cost you a penny, 3 free compliance management webinars that you can access to. Several of them directly about culture. If you want to make sure that your management team is going in the right direction from a compliance management culture CMS standpoint, make sure you check those out. Letter C, didn't talk about this a lot today. Complaints and complaint management. I'd put it right up there next to fair lending. In fact, in that fair lending webinar that they did earlier this month, complaints is the starting point for fair lending and many other things as well. If you don't have a formalized complaint program, it's not a matter of if, it's when, as far as I'm concerned, when it comes to your regulatory agencies and their expectations within your organization. Flood reform. We do have this issue in front of us that the flood insurance program has to be renewed long-term. Yes, there's that. But there's also other things on the table as it relates to flood reform. Updated guidance, penalties, things like that that are being discussed. So look for flood reform on the horizon. BSA AML, I'm going to combine letter E and F together. Ongoing customer due diligence. Make sure that you are continuing the strong path forward from May 11, 2018, where we had the mandatory formalized beneficial ownership requirements go into play, but also a formalized customer due diligence program had to have been implemented at that same time. Make sure you've dotted the I's and crossed the T's there. We have several training options that we can provide you with if you go to our store on that area as well, but make sure you haven't missed the boat there. Banking marijuana businesses, that thing is just blown up. If you are banking marijuana businesses, make sure that you're aware of the guidance, make sure you're aware of the state laws, make sure you know how they interact with the federal laws. If you get into that area, know that you may have customers that are doing business with marijuana businesses and how to seek those out. Oversight in that area. Reach out to your regulatory agencies. That is a hot button issue. Also one that we're going to be tackling in the first part of January. Our first 2020 webinar is in fact going to be banking marijuana businesses and hemp businesses is going to be on that agenda as well. So we're doing a 1-hour webinar on that. So things on the noteworthy list that you need to make sure that you're staying on top of. With that, holy cow, that's almost an hour done and gone. The look back, the look ahead, noteworthy considerations. Let's stop there. Diane, I'm going to invite you to come in. I know we've got some people that have submitted some questions ahead of time, plus some that have come in live. Let's take about the next 8 minutes or so here and address some of those.
Okay, well, first off, I just wanted to clarify that back to page 3, letter K, the HMDA thresholds, we still do not have a permanent open-end threshold. We just have the temporary of 500 extended to 2022. So something else to stay tuned on, I guess. So
okay, well, I appreciate that. Appreciate that follow-up. Thank you so much.
Sure. So first off, how do we properly monitor for fair lending when we are not a HMDA reporter and don't have the data?
Well, you don't have what I'll call traditional HMDA data, but you can still, I mean, it depends on the type of loan. If we're talking about a purchase or refinance of the primary residence and you're a non-HMDA bank, you still got to collect race, sex, and ethnicity for those types of loans. You can voluntarily collect things like credit score, loan to value, debt to income ratio, age, marital status. You can still collect that information from your applications and use it as a monitoring tool. You should be monitoring underwriting and pricing exceptions. So when you don't follow your policy, all of that can be tracked. So you do have the ability to use non-traditional data, or some of it is traditional, is what new traditional HMDA data that you voluntarily collect. You just don't report it and submit it. So you can still do it. You just have to be creative with how you do it. You can't collect race, sex, ethnicity on loans where you're not allowed to. So you can't go that far. But this other stuff you can collect.
What's expected when it comes to fair lending monitoring for purchased loans when the financial institution doesn't service loans?
If you're buying loans from another party, you need to make sure you've done your due diligence on that other party, because if they're discriminating and you're buying their loans, you're going to be in the same kind of trouble that they're in. So make sure you're doing proper oversight of the third party that you're doing business with, even if you might not be servicing the loan and just buying the asset.
Can you charge an origination fee that would encompass other fees normally charged in a residential real estate transaction? For example, you charge a $1,000 origination fee from which the credit report, appraisal, and flood determination fees are paid.
That's one of the beauties that TRID brought to the table, is that you can actually do that. Under the old RESPA rules, you couldn't. You had to itemize everything. Under TRID, you can do some of that where we're just going to charge an origination fee. We're not going to charge for these other things. Now, some of those items that you mentioned, Diane, would not be finance charges, but an origination fee is. So you give up that difference, or that ability not to include it, but it makes it maybe an easier approach for you. So the answer is yes, you can do it.
If any fees in the 10% bucket lower from the loan estimate to the early closing disclosure, should we update our tolerance basis with the reduced amount?
Yeah, so if we estimated $300 for a survey and it comes in at $100, our tolerance dollar amount we get to use is $300. We don't have to lower the number for that service so long as the service is utilized. But if we don't need a survey and we estimated a $300 survey, then we have to drop the $300 survey out of the bucket. It only gets to be included if we use that service. If it comes in cheaper, great. We don't have to lower our tolerance number because it comes in cheaper, though.
Does the Reg B appraisal notice fall under the requirements of the eSign Act?
This question has come up about every week as I've been out training, whether it's online or on the road, in the last 2 months. And so the appraisal notification requirements under Reg B. There's two parts of the appraisal requirement in Reg B. There's a notice and a free copy of the appraisal. Both are subject to eSign. So when you deliver the notice, it's got to be eSign compliant. When you deliver the appraisal, it's got to be eSign compliant. Now, they do have an additional instruction for the notification. The notification does have an exception for eSign when the application is an online application and the Reg B appraisal notice is provided with it. If I go to your bank's website and can get the application to apply and the notice all in the same spot, then it's not subject to eSign. But all other appraisal notices would have to comply with the eSign requirement. And the actual copy of the appraisal always has to comply with the eSign requirements.
If a customer asks what cash dollar amount they can deposit before we file a report, is a SAR required just because we had the conversation?
Very likely, yes. I don't want to paint the kettle black and say 100% of the time, but if somebody's asking about how to structure, then structuring likely is imminent or has happened, and you get your BSA ML officer involved, and they're going to help you out with that one.
We have a private flood insurance policy from a borrower with 3 different businesses. Our loan is under business name number 1, but the flood insurance is under business name number 2. Will this work? The property address is the same on both.
So I've got a private policy that covers the property. The business names are different.
Right.
As long as the property is covered based on the lesser of calculation, and the bank's gonna have to be listed as the lost payee, as long as seeing if I can find this one here. Borrower has 3 different businesses. I'm not sure I'm concerned with the business names. As long as the property is covered and the borrower is covered, we should be good to go, because flood insurance requires that the borrower be protected and that we have the amount in the lesser of calculation. We should be good to go there.
Okay, I have some confusion within my bank on the requirement to redisclose a loan estimate with an APR change. Is there a hard and fast rule on this?
There is no rule in TRID that says you have to redisclose a loan estimate when your APR increases or decreases, nor is there any tolerance related to it. That's an old Mortgage Disclosure Improvement Act rule that was part of Truth in Lending before TRID. TRID wiped it off the books. And now the only time you have to redisclose based on APR issues is when you go from closing disclosure to closing disclosure. We'll do one more, Diane. I think I've got the top of the hour rolling around here.
Okay, this one takes us back to the HUD and Facebook case on page 2, item F.
Yep.
Does this only pertain to third-party marketing of lending-related products, or should we be concerned with such marketing for deposit-related products?
The CFPB has been very transparent about its desire to create a fair marketplace on the deposit side. And while it's not fair lending, you shouldn't use fair lending prohibited characteristics to market deposit products either. That's a bad decision in my opinion. Also, if we're talking about overdrafts, those are incidental credit, and so those would be subject to all the fair lending laws and restrictions. So I think I'd be very, very careful on what you do with the deposit side as it relates to prohibited factors. I wouldn't steer there. I'd turn and go the other way. With that, we have the top of the hour here, and I want to make sure people plan their days out, and they've got meetings they got to get to, so I don't want to hold anybody any longer. But I do have a few things in closing here if I can. Before you all check out, I do want to let you know we do this free forum 4 times a year. The 4th installment, the one you're currently on, this is our look back and look ahead. The other 3 work like this. We're going to be doing the first one in 2020 in January. The first one is going to be a lending Q&A. You can start submitting those lending questions today if you'd like, and we will keep them, and we will answer as many lending compliance questions as we can get to in that 1-hour time frame on January 15th. The other 2 that we're going to do next year, we'll do one on BSA AML questions and another one on deposit operations compliance questions. The 4th one will always be this a look back and what lies ahead experience. So you know what's coming. You can go register today. That will be available out in our store. If it's not already, it'll be there very shortly. In closing, there's a short survey that will have popped up in another window. We'd love to give you some feedback on today's program. Please take a moment or 2 to fill that out. The recording for today's program will be available within 2 weeks. You'll be able to go access this and listen to it again or provide it to other valued members of your team. We want to thank you all for stopping by for a little plain English as it relates to what has happened in the last 9 to 12 months, as well as peering off into the future so that we can give management and the board some ideas on what's going to happen in the coming months. With that, we'll let you get back to doing what it is you do best, and that's serving your customers. Thanks again.